Hello students, welcome to my class. This is Professor Vincent Osaya. This is part 2 of chapter 2 presentation, the financial statement auditing environment. This is where we left off in part 1. We were talking about the context of financial statement auditing. In summary, we said that the industry in which a company operates in, or the type of business that a company operates, has a whole lot to do with how an audit is conducted. So here is a third question: How would your concerns about the inventory account differ for a computer hardware manufacturer versus a jewelry store? What are we talking about here? So the question is, if you are auditing a computer manufacturing company versus a jewelry store, what are your concerns relative to inventory? Both companies have inventory, but your concerns are different. How? For a computer hardware manufacturer, your concern primarily would be whether inventory is properly valued. In other words, as you know, computer hardware are subject to being obsolete, because every 3-6 months there's a new invention in the computer hardware industry. So the question that, or the concern that you have as an auditor is, yes, this company has $100 million in inventory. The question is whether a significant percentage of this inventory is not being obsolete. If that is the case, the question is, was proper adjustment made by the auditee or the company that you are auditing? If proper adjustment is not being made, it is likely that the $100 million of inventory is being overstated or overvalued. Now, if you are auditing a jewelry store, different industry, different business nature, different type of business altogether, you would not worry about that. Why? Because you don't have to worry about the gold being obsolete, okay? What you have to worry about is whether the inventory properly reflect the value or the cost of the inventory. So it's a different industry, it's a different mindset. The inventory account in terms of your concerns are quite different. So that is an example, or a good example, of a context of financial statement auditing. So moving along, let's take a look at the model of business. Here we said that business organizations exist to create value for their stakeholders. I would say due to the way resources are invested and managed in the modern business world, a system of corporate governance is necessary through which managers are overseen and supervised. What does that mean? Let's zero in on some of the key words here. Create value. How does a business create value for the stakeholders? There are different ways of doing so. Hiring competent, knowledgeable people will help you create value for the stakeholders. Okay, making sure that you are on top of the game in terms of what you are doing in your industry also create value for the stakeholders. But the most important factor that is more important than every other factor at the end of the day for publicly traded companies is the value of the company stock. Because if you are doing everything right, then that is going to reflect in an upward trend of the company's stock in the stock market. So now, the next question is, who are stakeholders? The stakeholders are everyone that has an interest in the company's operation or in the company period. And the number one stakeholder obviously are the owners or the shareholders. Another thing that I want to zero in on here is corporate governance. What is corporate governance? We said that corporate governance is the overall system that you put in place to make sure that all the processes of the company are well carried out. By so doing, you create value for the stakeholders. So let's take this again. So business organization exists to create value for their stakeholders. Due to the way resources are invested and managed in the money business world, a system of corporate governance is necessary, through which managers are overseen and supervised. Basically, all the processes have to be carried out properly. Now, we said that to make for good corporate governance, management is responsible to set up objectives, strategies, carry out processes properly, put controls in place, engage in different transactions, and ultimately generate meaningful report for different constituencies, primarily the stakeholders. Now, what does that mean? We said that, let's take a look at each component of this model of business objectives. What are objectives? We said that with the directives of the board, management is responsible for setting up a broad, long-range goals in order for the company to create value for their stakeholders. Now let's take a look at the strategies. We said that careful plan or method to achieve a goal deals with the strategies. In other words, in order for you to accomplish your objectives, you have to put some strategies in place to make it happen. So the strategies deal with careful plan or method to achieve your goals or objectives. Now let's take a look at processes. We have 5 broad processes, and we are going to talk about in great detail in the next slide. You know, one of the processes will be, those are the key areas of operation. For example, we have financing, purchasing, so on and so forth. Now, let's take a look at controls. We said that it makes for good corporate governance for management to put in place proper controls. These are controls that will safeguard the company's assets and make sure that every employee is doing what he or she is supposed to do. Now let's take a look at transactions. In order for us to accomplish our objectives and execute these strategies, the company has to engage in different transactions, okay, or carry out different transactions between the customers, between vendors, between employees, so on and so forth. Then the last thing is, ultimately, by the time you put all these pieces together, meaningful, complete, accurate report or financial statement has to be generated for the stakeholders, be it the shareholders, management, so on and so forth. So that is the report part of the model of business. So moving along, let's take a look at the next slide, a model of business processes, 5 components. Now I want you to note that here we are talking about processes on the last slide, 5 broad processes. So we are going to go ahead and take a look at the expansion of processes here. So this is the lower level of a model of businesses. Now let's take a look at these 5 components. Number 1, financing process. What does that mean? Every manager or the management is responsible for going about obtaining financing for the business. Now, financing comes in 2 fashions, either in the form of equity or in form of debt. In other words, you either ask the owners to put money into the company or you borrow money. How much of that are you going to do? What is the best combination? That management has to figure it out. Number 2, by the time you obtain all the financing that you need, assuming that you need $500 million to operate the company, then you have to go about, you have to go ahead and engage in the purchasing process. In other words, buying goods that you are going to be selling or putting things in place to provide services for your customers in order for you to create value for the company. Then, by the time you are done with that, then you have to go about the activities of engaging transactions relative to human resource management. Okay, so you have to go ahead and hire people. How many people do you need? What kind of caliber of employees do you need? You have to figure that out. So that is the human resource management component of the process. Then another important piece is the inventory management process. Now, that is not applicable to every company. In other words, inventory are goods that you buy that you intend to sell to your customers. So a service type of business don't have to deal with the inventory management process. But nevertheless, if you have a business model that deals with inventory management process, the questions that you might have to ask yourself is, how much inventory do we need? Now, too much inventory could be counterproductive because you have a lot of money sitting down doing nothing. At the same time, not enough inventory could be counterproductive because a lot of customers are going to be turned off. So what is the best mix? Well, management have to figure out issues like that in the inventory management process. Then, of course, the revenue process is important. You now have to go about either providing services or selling goods to customers in order for you to create value for the stakeholders. So moving along, let's take a look at an overview of business. This diagram basically summarizes everything that we just talked about in the last 2 or 3 slides. So moving along, let's take a look at the organizations that affect the public accounting profession. Now, we have the Security and Exchange Commission, SEC. That organization is very important because that is a federal government body that is responsible for policing the financial market. So you go out there and buy stocks, bonds, commodities, options. So that the SEC is the police force. And SEC is also very important because they actually have the ultimate responsibility to come up or to establish accounting rules. They actually really don't do it because they pass the responsibility to the next organization, and that is FASB. So the next organization that affects a public accounting profession is FASB. You're already familiar with this in your financial accounting classes. Financial Accounting Standard Board. That is the organization that is responsible for establishing accounting standards, accounting rules that every accountant has to comply with during the course of doing our work. Then we have the International Auditing and Assurance Standards Board. That board issues international standards for auditing. You know, we call them international standards audit. So that is the IAASB. Then the next organization is the Public Company Accounting Oversight Board. That is the board that came into existence when the government stepped in and started regulating the publicly auditing in connection with publicly traded companies. So we are going to talk about the Public Company Accounting Oversight Board more in details eventually. Then we have the AICPA. That is the organization that is responsible for a lot of things. Number one, they are responsible for administering the CPA, the uniform CPA examination. That body is also responsible for coming up with auditing standards for non-public companies. Then the last is the International Accounting Standard Board, IASB. That is the international counterpart of FASB. FASB come up with accounting rules and accounting standards for accountants in the United States, while the International Accounting Standard Board is responsible for establishing accounting rules for international for countries that decide to use those accounting standards for preparing their financial statement. And their rules, we call their rules IFRS, which stands for International Financial Reporting Standards. So I think that is the conclusion of part 2 of chapter 2 presentation.